Hello everybody, my name is Drew Demon and I'm the Devil Stockbroker. Just doing a quick update on the SPY since we just had the Powell pump and dump crash that just happened. So quick review on the technicals of what we've had on the daily chart for the last several weeks. Most recently, the MACD was trying to break out and cross over on the 12th. We saw that rejection when the SPY couldn't get back above 412, and we got rejected pretty harshly after that. Now we were testing another area of support this week, starting Monday, trying to break above 390. Again, failed to break out and have been chopping this entire week for the most part, up until today, where we have the basically the biggest reversal in the market in such a short time span. We'll actually go switch down to the 15 minutes so that we can see this. So immediately, we were expecting the FOMC minutes to show a huge rate hike, and we did get the rate hike. I was personally expecting a 100 basis point hike. We got 75. And my reason for that was that 100 points would indicate that the Fed was actually taking a tremendously strong stance to shock and awe the market, and we would see a crash begin to really happen in the market, but it would create enough shock and awe to maybe fight inflation off quickly enough that we would not have to go through a massive amount of pain over the long term. But that's not what happened. The Fed decided on 75 basis points, which is still rather strong relative to history, but in our current situation may not be strong enough. And so I'm actually a little bit, I'm more bearish for the long term of the market now because of this decision. The Fed is planning to raise rates, according to the latest minutes, between 100 and 125 more basis points between now and before the end of the year. So we expect the market to continue to attempt to price that in, which will see interest rates increasing up to beyond 5% once we achieve an effective federal funds rate at or around those levels. The actual FOMC minutes, as soon as it was released at 11 o'clock, we saw a massive drop in the market. This was actually a big exit opportunity for puts because the 75 basis point hike was already priced into the market. So the chop that occurred here was actually rather predictable. As soon as we broke the 382 or the 381.50 level, this resistance where we had this tweezer bottom pattern, that was an indicator that we were going to double bottom and bring ourselves back up. As soon as Powell began to speak that afternoon, about 30 minutes later, the market recovered extremely rapidly, jumped all the way back up to where it started at 388 and crossed above previous resistance where we had this top and filled this gap. So we filled two gaps actually, this one here and this one here. Both of these gaps were extremely significant, but we have huge resistance at this level, and as you can see, we failed to break it. So as soon as we saw Powell step off at the end of his speech, the market printed an indecision candle, and we saw big sell-off from that point forward. Now, we are anticipating the market is going to continue to sell off over the long term. Things will continue to get rough in the macro market. Banks are going to have a harder time with transaction of funds. Lending will get more expensive, and corporations that are reliant on continuing their financing in order to stay in operation are going to have a harder time getting that financing. And we expect that a lot of companies are probably now going to start going through earnings contraction. The biggest are probably going to be companies like Amazon, Tesla, and the big retail stores that are not in the consumer defensive sector. So companies like Costco and BJ's and Walmart are more insulated from this, but they will still be affected. Those companies will probably benefit in the long run from this inflation hike because they still offer best prices. But other stores like Target and other more expensive wholesaler retail or luxury retail are going to see major contraction of earnings as consumers go bargain hunting in order to keep saving money. So at this point, what we're anticipating is the market is going to continue to go down for the long term, but I want to point out this very, very crucial trend that is developing in the SPY that I don't want anyone to miss out or ignore. Keep an eye on this yellow trend line. So we're at a major inflection point in the SPY where, starting at the floor of the COVID crash, if you draw a trend along the bottom here and then continue that trend along the bottom of our most recent low on the 15th and 17th of June, where the SPY hit a low of $362, excuse me. This trend line continuation shows that we are only just barely hovering above it. So the SPY is going to chop for a while, okay? If you're not already in a short position that you had gotten into after Fed Powell had completed his speech today, then it's really too late to enter into anything expiring anytime soon. So keep an eye out for the market. It's likely going to start printing some indecision candles as we begin to flag out and chop the rest of this market. Okay, the minutes meeting was still very hawkish. It's going to stay that way, and the rhetoric is going to be rather negative. But the thing to watch out for is if we do not break this trend line very strongly with a closing candle that takes us well below this area of support. I mean well below. Like, we would need to close at 372 and hold there for us to see continued selling at the trajectory that we saw today. So I feel that it is more likely for the market to wick through this and then find strength and bounce and try to consolidate to the upside. This is going to, again, try to trap a bunch of bulls into thinking that this is a trending market or a trend reversal, and that the market already priced in the 75 basis point hike before eventually we do close below this trend and then we start to see the sell-off continue. It will take some time, so I'm emphasizing that people should be patient and cautious going forward, just because we got this massive volatility swing this week where we saw the SPY ripping and dipping at $10 differences throughout the day is probably not going to continue for very long. At the very least, our volatility is going to be in both directions, and the market is going to attempt to whipsaw people out. There are ways to profit from this trend. For instance, the VIX is probably going to get a little bit crazy these coming weeks. If we start to see the VIX developing more bearishness, as in that we see the VIX going and trending up, then wait for a down move, a downward swing in the VIX to find another buying area somewhere probably in the $26 zone. And if you can see a double bottom pattern in the volatility index, you see like the George W. Shout out to Trey's Trades. If you see a classic George W. pattern or anything of that nature where you see rising lows in the VIX, such as we've seen before, then the volatility that will come out of that will probably indicate that continued selling in the market, and you can use that to give yourself a heads up when the market is about ready to make its move to the downside. But overall, VIX is very undecided right now. This indecision candle with huge wicks is really indecisive at the moment. So I definitely see some potential for the market to go in either direction. And I just want everybody to know that going into the remainder of this week. We already saw a huge push to the downside, major short rallying and bulls stepping in at the very end of the day, and then the bears finally taking over and seizing control from the bulls. Now, the thing is that HYG, and this is not common, the HYG tracked the SPY the entire time this was happening. So SPY and HYG sold off extremely fast. Powell started speaking, and then HYG went up again, and then we tweezer topped and HYG sold off again. So we got the exact same moves in the bonds market, especially the high yield corporate bonds or the junk bonds market, identically with the SPY. That tells us that there is huge amounts of indecision and uncertainty on both sides of the market right now, and the bond traders themselves don't really know what's happening, and they're unsure where to place their bets. We saw the Treasury yield, the yield curve, is starting to come out of inversion, but we had a huge rise in the 2-year bonds. The 10-year is slowing down. What this means is that we may be waiting on the crash for a while longer, but it will still be coming. So if you're holding on to major put positions on other firms and companies that I've mentioned in the past, just be really careful with those. We may yet see some rapid selling throughout the rest of the year. We still have the rest of September and October to get through. And seasonality dictates that we still are due for some big selling pressure. But before that happens, we're probably going to see the market pump just a little bit, especially in defensive and energy sectors. So pay attention to things like the XLV index, which is the healthcare sector, the XLE, which is the energy sector. And you can take a look at things like Dow Jones and other indexes that center around the consumer defensive retail sector, such as XRT, looking for those stores that are basically what consumers rely on to get their basic needs met. Overall, I still anticipate things to be very bearish for the tech sector. So if you're short on the tech sector, then you're probably positioned well for the rest of the month. It's just be ready to endure some chop for the remainder of this week and probably early next week before we get that last big flush in the major tech companies. Tesla especially broke down in a big way. It finally set a new lower low and closed far below support on both a rising and a declining resistance. So rising support was broken, and we broke this declining resistance line here for the let's see, this is the first time we've broken below this since we broke out of this flag. So Tesla is looking probably the weakest out of all of them, although I would say that Apple is not doing any better. It triple topped on a on a big wedge here. So this was a really rough pattern for Apple to break. So you had this rising wedge. These tend to break to the downside, and of course we did. And now we are back into a bearish pattern on Apple. So between Apple, Amazon, and Tesla, those are three heavyweights in the SPY that are likely to drag it down, as well as the Qs or the NASDAQ sector, whichever you prefer to track. So going forward into the next couple of weeks, look for those re-entry opportunities for puts or just rolling out contracts that you have for longer distances, and give yourself plenty of time. As always, not financial advice, but these are the things that I'm paying attention to for the market to continue a sell-off long distance going into October. SPY is especially weak right now, but just be ready for that whipsaw for the rest of this week. They're going to try to shake people out of positions and really mess with the psychology of traders, because now things are starting to get more scary for the institutions and for the broader market. And retail should be as well positioned and prepared for that as they possibly can be. I'm going to open this up to the Discord. If you guys have any questions, go ahead and just let me know. What are you guys thinking?
Just a comment. Something I've been doing since June of last year. I've stayed about 60% cash,
Mm-hmm.
and I'm usually out of my longer term positions within a quarter. but I play quarterly rotations. Something people might want to look at is look at sector rotations and think about things in a short dated position, so you don't get caught in the downturn and you're sitting there holding on to equities that you got to wait a quarter for them to even get an opportunity to come back.
Yeah, make sure you're entering at the top or bottom of a larger channel too, and that there's you're aware of any special events, news, strikes, earnings, dividends.
Yes, that's an excellent point. Getting in at the top of channels or as soon as something breaks out, like Tesla, for example, this big rising wedge in Tesla is a perfect example. Like if you were going to trade more risky, you would trade at the top of this pattern and wait for the breakdown and trade that way, catching those moves between each side of the pattern. But your confirmation is not until you see those breaks and you see something either break out of a channel or as soon as it's at the top or the bottom of a channel and then choosing a direction to go back to the opposite end. Waiting for those confirmations is very critical. You don't want to catch a move in the middle, like, for example, here or here. Like you think that it's going to keep going up and then, well, the top is in and then you just suddenly lost your position the very next day. Things like that are exactly what the institutions are going to be trying to trick retail participants as well as other institutions into doing. So the moves to come, you want to make sure that you are really paying close attention to the technicals, trading at the tops of channels before going to the downside, or trading confirmation breakouts to the downside, waiting for those confirmation candles, guaranteeing you, well, not guaranteeing, there's no guarantees, but at least giving you more certainty that once you have had those breakdowns that you are correct and that you can expect the selling to continue. Or if you hit a bottom and you get a more bullish pattern, that you can expect the buying to continue. So things like that are important to pay attention to going forward. The technicals will save your life and your portfolio. To Soldier of Fortune's point, I appreciate you bringing this up, by the way. If you're in the market for the long term, given that we are in a bear market, you're kind of fighting the trend right now. And that's okay to do if you're willing to hold your positions for a very long time. But if you're trying to make money in this market right now, um, and you're waiting to, and you want to buy things when they are at their cheapest and move from the bottom of this crash in order to follow the recovery to wealth, then moving to cash is a good strategy. Slowly getting out of positions when you have advantageous profits or at least good prices that you can get rid of them, and then being able to consolidate your cash in preparation for that recovery will give you a greater deal peace of mind. And of course, if you need that cash, you will have it when you need it, and you won't have to sell in a panic when things have already fallen apart and then something happens. Like, things happen. Somebody needs to go to the doctor. Somebody needs to, somebody loses their car. Things can happen. So don't ever put yourself in a position where you need to get emergency cash by liquidating assets in a market that is already in its worst position. Instead, have that cash set aside for when you need it. Be ready for when the market turns back around so that you can jump in and buy things at their low. And if you end up needing that cash, well, you already have it. And then you're not panicking. It's better for everybody's peace of mind, which is ultimately better for your trading and your financial future. Thank you for bringing up both of those topics, guys. Let me check what folks are saying in the text chat. Zeke, yeah, we can take a look at the IWM. So, Savvy, I see your call on Open Door. I'm also very bearish on Open Door. Savvy Trading said Open Door Technologies' short percent of free float has risen 13.1% since its last report. The company recently reported that it has 770 million or sorry, 77.36 million shares sold short, which is 13.8% of all regular shares available trading. I am not going to play a short squeeze on anything that's exposed to the real estate market. Open Door has really screwed up. They're one of the real estate companies that have actually backed themselves into a corner buying a bunch of real estate on speculation with the hopes of turning them around quickly. They've really screwed up. They really misjudged the market. So I am not surprised that their stock is just in free fall right now. I would not bet on any kind of a short squeeze for these guys. There's no relief coming for this company. That's just my thoughts. I think that this company will probably go to a penny stock and probably end up having to reverse split eventually, is how negatively I see this company. They are now in a spot where they are holding on to a bunch of depressed properties, a lot of really expensive properties that nobody can afford, nobody will rent from them, and they need to get rid of them, and they're going to start taking losses. And I'm seeing on listings, even in my own real estate market, my local market, where open door company or open door owned houses are repeatedly going onto the market and they are listing for far below what they paid the house for that house. And I'm seeing literally dozens of these listings going up all the time. They are struggling right now, and these guys are going to keep losing money. So, in the same way that I am betting against the housing market, I would also be betting against these guys. So, if you're looking at short interest and only considering the possibility for a short squeeze, these guys messed up really badly. So, I will not be looking for a short squeeze in these guys. At best, I would expect there to be like a short rally once shorts have finally decided they've had enough and they're ready to take their profit, and that buying pressure of them exiting causes the stock to pop. And at that point, that's like an opportunity to go short again and ride it straight back down because there's no relief coming for
You
these guys. That's just my thoughts.
you also got to think too, TD. If you listen to Chair Powell today, he talked about shelter inflation was going up, and they don't really have a tool
Mm-hmm.
to help it because it's so sticky. Like I
Yes.
could see Open Doors earnings continue to be diluted quarter after quarter after quarter just by this really sticky inflation.
That too. And they're holding on to these empty properties, which is going to create a drain on their balance sheet constantly. So they'll be holding on to hard assets, but they're illiquid assets, and they're a constant drain on their on their cash balance because they have to maintain them and keep building them up and trying to sell them. And that is by definition going to create a loss. And things are about to start getting really bad in the housing market now because now we're starting to see foreclosures only beginning to start appearing. Like the pre foreclosure or the pre sale numbers are starting to rise really fast, and that is going to start scaring people. And then we start to see all these properties end up on the market for like really cheap prices. So Open Door at that point will be quite literally backed against a corner with flames all around them, and the only choice is to run through the flames blind, hoping that you find an open escape route to get out. But no matter what, they are going to get burned very badly on their exit, and they may not survive. They are really trapped. So this is not a company that I would want to be long in at all. Okay, I
That's a
see.
very interesting after-hour candle on AMC.
I'll take a look at AMC really quickly. Then we'll take a look at IWM. Ooh, that's funny. Yeah, AMC pumped with the market, and actually, it looks like it outperformed SPY, and it closed. Looks like it closed above. Let's see. It's an indecision candle, still a little bearish, but that's interesting. um, we'll take a look at IWM to look at the Russell 2000. See where that's at. We are completing a head and shoulders pattern, and we have broken down below. So next stop is probably going to be 170, 165 maybe at the low side. So we've got these two areas to watch for. The the Russell 2000 index is pretty diversified amongst small cap stocks, but it's filled, absolutely filled with zombie companies that are going to be losing money for a while. And if they don't get financing, they're not going to be saved. So you'll see bankruptcies start to drag companies down on IWM. And honestly, this one's probably going to hurt bad, but it's a question of whether it's going to be bad, as bad or worse than the SPY. And I think SPY might actually be worse because there's a lot more room for stocks in the large caps to go back down because those really overextended themselves. They got way too expensive during the market pump in the bull market that we just had. And their PE ratios are still insanely high. Like, I think Tesla's still in 3-digit numbers on its PE ratio, which is insane. So, IWM is probably more modest, but it is going to be subject to earnings contraction in the next quarter. I wouldn't treat IWM as any kind of a hedge. It's pretty much moving in tandem with the SPY. You can confirm this by doing IWM divided by the SPY to get the ratio chart. And you'll find that for the most part, at least since January of this year, they've pretty much chopped together. For the majority of the time, IWM just slightly underperforming SPY. So currently in this week, IWM is outperforming SPY, but I wouldn't treat this as like any kind of a hedge. So just anticipate that IWM is probably going to move with the SPY because it's dealing with all the same kinds of problems that the broader market is. Okay, I saw energy sector and XOM, so I will take a look at XOM. This is an area of support that I'm anticipating for XOM to hold. $90 was a good buy level for me on XOM. The one issue is that we had this big gap down candle that then filled. So this is the only reason why XOM got down to this level in the first place. Now we've filled that gap again, or well, we've returned to that level that was filled by that bull rally. Now we are at this support again, and there's no further support until we get back down to around 89.75, which is, it's still okay. U.S. oil is starting to really chop, but the news that I got most recently is that the government is going to be buying oil. They've confirmed they will be buying oil in order to replenish the reserve, the U.S. oil reserve. They've also sold some of it. They recently this week sold some of it into the supply in order to kind of help out ailing sectors that needed access to it, just because the price of oil is still a little bit expensive. But when the government decides that it's going to start buying back oil, then the prices will start to go up, and we'll start to see the futures market price that in. Oil market's been in decline for quite a while, and now we're at an area of significant support. So the chop is kind of natural to expect. So we're right here, and we've stalled out in this area before. We actually were trying to charge through it for some time during the bear market, the early bear market, when the Ukrainian conflict was going on. We're seeing some positive news coming out of Ukraine, what with the Ukrainian counterattack against Russia being a massive success, which is very encouraging to hear. I always love hearing about Putin getting his ass kicked. But we're currently chopping through this area, but we are not breaking support, and we have established a higher low so far. We have to see where our next green candle prints for our confirmation. But if we get a bounce off of around 81 cents or 81.50, then then that would confirm a double bottom. So we are looking for a double bottom right about here off of this zone. We're close. We just got to wait for that to happen. I don't think that OPEC is going to let the oil market crash. We'll likely see U.S. oil return, maybe not to 120, but to $100, I think is well within reason. I'm trying to be conservative, but ExxonMobil is still in a good position, and we do see that it is finding some support here near its Fib 38 level. So we get a bounce here, and I think that it will clear the 62 Fib level shortly thereafter. We'll see Exxon trading back above 95. I still have my original target of $100 on ExxonMobil. I just am waiting for this flag, this bounce off of this larger bull flag pattern to be confirmed. It's a choppy market right now, so things are a little bit uncertain. Okay, I hope that helps. UPST. I'll take a look at it, sure. Upstart is the it's the Upstart Holdings. It's like the micro lender, if I remember correctly. Okay, so we did get the bottom, but we have a very bearish doji candle on this, so we have to watch really carefully. We've had two very tall wicks on these, so it's tried to break out and it's failed pretty strongly, and now it's starting to get lower. If we look at this on the hourly, I want to set up this support line right here. Let me switch this to another color so it's easier to see. And I'll go to an hourly chart. Okay, so we did triple bottom. We have one bottom, two bottom, three bottom right here. So if we print a reversal candle here and we break out of this descending level of resistance, then we can see the stock return to new heights. It is possible, but just be careful because Upstart is in a very exposed sector to this bear market. They're subject to the lending market for microloans and mortgages and stuff like that. So if lending becomes more and more expensive, if people start defaulting on their loans, Upstart can get in trouble in a hurry. So their performance as a company may have hit its bottom. If that is the case, we'll see it soon with the technicals. As I've pointed out before, this is looking like a very nice diamond bottom pattern. It does look really convincing, but I just want everybody to be really careful. Because this can get you into trouble if it breaks down. So we're right at that critical inflection point. Don't rush it. There's plenty of opportunities to enter, and if you wait to get that confirmation, you will not regret it. But if you jump in too early and you're wrong, or I'm wrong, I guess in this case, because I'm sure people will blame me. But if I'm wrong and this doesn't complete, if you don't wait for this breakout and confirmation to break this level, we've got to break out above here. If that doesn't happen, then this can move down with the rest of the market. This is a very exposed sector, so this company needs to do something impressive to really bring attention to it and secure its place in the hearts and minds of the lending sector. There are some companies that do really well here when they survive these crashes. And if this does end up moving, then this is the entry versus take profit difference. You can see a 53% difference between its move, and that's based off of this high, this low to high. That's from here to here. So you move that over to the breakout spot, which is where we saw the last bit of resistance. You move it right here. And you would enter here and take profit here. That would be the move. You can try entering early if you want to, but know that you're taking a risk doing that. Like you're taking a risk as it is with this type of pattern, because it doesn't always play out. It's just one to keep an eye out for. If you can get a very cheap entry for a long distance, like leaps for 2 years, and you can spend like maybe like a couple $100 if that's within your risk tolerance, then that can end up being a very profitable position in the long run. But do expect to hold this for the long term, because this move will take a long time to actually play out if it does happen. Like it could take a while. But if it does happen, then you'll have a really nice, good early start to building your portfolio after the market crash is over. Okay, that's going to be it. I appreciate you guys coming forward with questions. Thanks very much for throwing those to me, guys. I hope that you find this helpful, and this gives you some ideas for what to look for in the market going into the rest of the week. Things are going to get pretty choppy. I'm going to be on a plane tomorrow, so I won't be able to participate with you guys, but I'll be with you in spirit from 50,000 feet. So y'all take care, and I will see you next time. But in the meanwhile, have a hell of a time in the markets.